And hi, everybody. It's May 27th, 2020. My name's Stephen Hodgdon, and this is Modern Asset Management. And tonight we're going to be talking about a simple seller finance deal and to explain how you take a rehab and turn it into a rental and into a mortgage. So I'm going to start my screen up and start my slideshow. So this is again, this is a rehab project that we did 3 years ago, and it was done with a company called Sunrise Acquisition Services in Pensacola, and came out just fine. And I thought, instead of talking about trouble like I usually do, I should talk about one that rolled right along and did just fine, and we'll see where we go. So 932 Montclair is a 1959 3-bedroom, 1-bath house in in not the ghetto, but not a not a super good area in Pensacola, Florida. It's in a neighborhood of all single-family houses, and it's lower. I'd call it a D property. It certainly was a D when we bought it, and we improved it some, and then sold it on a contract to a family, and so here we go. I figured to help those folks that listen to this on YouTube later, I might as well start at the end and then see if there's interest in folks listening. So I'm going to quick run through what we did. Original purchase price was $31,000. We paid about $10,500 in rehab and other fees to get it going. We had $3,000 in this and that added up over the 6 months that the project took. So our total expense side was $44,500. And on the income side, we rented the property for 3 months to the eventual homeowner as he was raising his down payment money. And we then collected 2 months worth of mortgage payments, and we received $5,700 at the closing table. And we wrote 2 mortgages. We wrote a first mortgage for $45,500 at 10% for 15 years. And then we wrote a small second mortgage for $13,000 at again at 10% for 10 years. Now we're roughly the same cost in, and the amount of the note for the first note is about the same as our total cost of the property. And so the $13,000 note I kept. I sold the first $13,000 note I kept, and over the course of 10 years, it'll earn about $7,000 in interest. So 44,000 in, 74,000 out. Pretty good. And so this is 932 Montclair. Just before we started, it says it's 3 beds, it's got a carport. This giant tree got cut way back, along with the landscaping cleaned up, and et cetera, et cetera. We didn't turn it into a complete end-to-end gut. We didn't need that. We made it back to be, the Sunrise Acquisition folks made it back to be usable and functional for a first-time homeowner. So we picked it up mid-flip from another investor. Some work had already started to be done. We primarily had a one-man crew. We had Jason on this for 3 months with help when he needed it. We rented to the future owner while he gathered the down payment. Our exit from the very beginning on this property was to do a seller finance contract. And so it is a non-qualified mortgage borrower. He's not a legal resident. Part of his income comes from cash. He's a tradesman. He's an electrician. But he was a father. He's a father and has two kids, and wanted his kids to not grow up, not continue living in an apartment. He's still in the residence 3 years today. Every mortgage payment has been absolutely on time. He's I think he's there. I think he's there to stay. So, what did we do? The deal structure, again, was the thing that I'm trying to learn to do more and more, is to begin with the end in mind. We could have, but we had other options. We could have cleaned it up and sold it, just a regular retail sale through a real estate agent, or posting a sign and selling it ourselves. That, for cash. We could have turned it into a rental. It would have rented for $650 a month. But again, I was trying to make notes, is what I was in the business of, what I was trying to do, and I think I still am. We made sure that they brought 10% to the closing table, of which we netted $5,700. So I wrote 2 notes, and my intent was to recoup my capital by selling the first mortgage. And so we wrote a 45, I forget if I got a typo there, 44.5 or 45.5, 10-year, 15-year note at $488.95. And I sold that note. Again, it had 5 months of seasoning between the rent payments and the mortgage, to an investor for 96% of unpaid principal balance. That note's boarded with Allied Servicing. I think they charge about $15 a month for management, and they do a good enough job. They take payments and they remit timely to the current mortgage holder. And so again, I've got this 15-year note, and then I wrote a second for as short a period as the borrower could afford, and that turned out to be 10 years. And that pays $178.19, or I think, every month. And we collect those payments we run a loan business. We collect those payments ourselves inside of our loan management software through a monthly ACH. One of the things that I did differently than what you'll hear in lots of folks with way more experience with me, but I wrote mortgages instead of contracts for deed. We've gotten advice that says you write a contract for deed because it's much easier to foreclose, because you're not actually foreclosing, you're repossessing, and that it's more in favor of the lender than it is the borrower. My feeling then, and still is today, that if coming into the deal thinking there's a likelihood of default, then I shouldn't be doing that deal. I'm not in that business. There's lots of big companies, Aquin, Harbor, that are in the business of loaning to repossess and then sell again. I wanted this to be one and done. One of the other things I do have on this is I have a first right of refusal to buy the property should the homeowner ever decide to sell. And so again, we bought the property for $31,000. We were all into it for $45,000. Zillow today, that was just this morning, says this property is worth $78,000. I think it's one of your classic inflated estimates. I think it's certainly within 90% of that, so it's certainly $70,000, and it's been kept up and improved since we sold it. Since the homeowner is an electrician, he's done work on the house. So this is going to go really fast, by the way. So, excuse me. What are the 3 pieces of a good deal? And it's win, win, win. It's a win for me financially. It's a win for my partner on the ground, Sunrise Acquisition Services. Got paid to do this work. They not only sourced the property, repaired the property. They also found me the buyer. So so they did okay. I I've learned that I've learned that maybe I didn't pay them quite as much as they earned, but that's all right. Well, it's all right with me. It's probably not all right with them. But lastly, the win is to the homeowner. He got a 3-bedroom house, a large backyard, for about what he would pay for a 2-bedroom apartment, maybe a 3-bedroom apartment. So he got a better place to have his kids grow up. Things that make it a good deal are it has to be a property that's easy to sell. I've had some just awful situations with investing in high-end property that has a much more limited buyer pool. I could have sold this property any number of ways had we not had this buyer come up. Could have easily sold to another investor to be made a rental. It's a solid, like I said, a solid $650, probably now $750 a month rental. It was sold at below what the average market price would have been. We didn't grossly overcharge, as some do when they do a seller finance contract. The price of the property was fair to other properties that were available. By selling direct, we saved all the realtor fees. So we didn't just pocket that. We made sure that the property was priced right. And again, mortgage payment below renting. The asset that you've got to pay attention to is who you're renting to. I'm a fan of Section 8 rentals, but then you've got to be very particular about who you put in. I wanted to make sure that the buyer that we put here was somebody who was going to be able to maintain the property and treat it well. I had one other property in a sale like this that the homeowner was not as stable as we thought. And when we got the property back, we had an awful lot of fix-up work that needed to be done. And it cost about a year's worth of payments to put the house together to go back out and rent it. The boots on the ground that we talk about and we hear about is so critical. I'm in California. This property is in Pensacola. But even if I was right there in Pensacola, I'm not a general contractor. I'm not prepared to do this kind of work. So I needed the right partner on the ground. So I've done, those of you that have listened to me before, you know that I started out in note investing with a pool of 30 plus notes in 12 states and learned pretty quickly that was a mistake. I needed to narrow my markets so that I could have better partners that knew me and that I knew them. We made sure that the contractor handyman that was doing the work at the property was paid fairly and paid early. Those folks are cash and carry people, and when you get a good one, you've got to do your best to keep them on your job, because there's always a better job for them to go and jump to. And the big win is we've got a borrower who pays via ACH on time every month. We never hear from him. We never have to call. And that's the best part of this, is you put in a year's worth of work and then it's on autopilot, in my case for 10. And so people are asking me, I guess because I host these things once a month, well, what do you think's going to happen? Let's just go with, I don't know. I got my own ideas, but I don't know. Based when we come out of this COVID stuff and where the world goes. But would I do this again? Yes, with some tweaks. I would move up a little bit in property value. From D up to properties that could be made into a firm C. In the Pensacola market, I'd be moving north of $100,000 as the entry point into the properties, looking for exits shy of 200,000, somewhere between 160 and 200,000. That market average price is about 230, and the higher you go in property price, the fewer buyers that you have. The If you go too low, and I've got some of those, you wind up with an unstable borrower who misses payments, and that's just headache for everybody, and we don't want to do that. So I would also set a minimum profit, quick profit of $20,000. So that's another reason that you have to move up, and I'd have to move up in property. Trying to make a fast 20 on an investment of 30 is it's there, it's there due, but it's it doesn't fit me for the long-term cash flow that I'm looking to build. Um, is now the right time to do this? Sure. I, yeah, I think it is. I think people still need to live someplace. Are we going to have price deflation in rents? Maybe. Are we? Who knows? But if you use the good old standard rules, what's your loan to value? What's your exit strategies? Are you your comparables the right comparables? And do you have a deal that cash flows? And is your financing, if you're using financing, does your financing line up with your deals? I've also gotten myself into trouble with projects that have run way too long and gone beyond the 1 year financing with the construction lender, which generates just more fees and more expense. And the only one that winds up making money in those deals is the bank. I was too scattered when I started this. I was jumping all over the place, doing deals, and here, there, and everywhere, and doing my darndest to learn as much as I could. And I wound up knowing a lot, and wound up knowing a little about a lot. And now that I've gone and dabbled in so many things, I'm coming back to as vanilla and boring as I can get, and have become more and more reliant on having great partners. And I'll say the name again: Sunrise Acquisition Services. I've done half a dozen projects with them, and will continue to do that. The takeaway for me is to really contemplate what could go wrong. Um, and I think, given the uncertainty of the world at this minute, we don't know what it's going to look like in a year. So if I'm writing a 15-year mortgage, I should make sure that all of the pieces that we can plan for have been planned for. I have another Florida property with the tenant is a daycare operator, and you would have thought up until last March that daycare businesses would never ever struggle. Well, all the kids were sent home, right? So we're these we didn't plan for a pandemic, and I don't know how many people really have. But she and I are getting through this together, and I know that she's going to be there when it's all over. Um, so that was the end of the share, and so pretty simple. I thought walking through what a fix and flip to seller finance was a spot where um, small investors have an opportunity to make a decent return with a minimal downside risk. There was no chance that that property was ever going to go to zero. So while we have a gross long-term yield of 30,000, if things had gone badly and it was only 15, well, I'd be okay. I didn't get hurt. and again, I wrote a note that was specifically written to sell. It had the right terms and the right dollar amounts and the right loan to value. It was a $45,000 note against a property worth 70. So there was plenty of debt to equity coverage for the passive note investor. So with that, we're going to take questions and a little back and forth for a little bit. You can feel free to unmute yourself and jump right in. Oh, I am looking at another project right now with Sunrise Acquisition. It's 3 houses on a larger lot in Pensacola, and so that's in the works. If there's somebody that is looking to find out more about that, my email address was in the slides. It's steve@modernassetmanagement.com. So anyway, floor is open for questions. Like I said, if this can be a short call. So.
Actually, I'm sort of new to the investing. My name is Sandra.
Hi, Sandra.
Hi. I see. So yeah, I bought one house in a tax sale here in Lake County, California, and that was actually really a good a project. Although it was my first, so you can imagine that I spent way too much and actually hired the wrong contractor. I mean, stuff like that happens, but I still came out okay. I bought it for 50. I put 70 into it, and so that's 120, and it's 180 now, right? So
Mm-hmm.
I did good, and I learned an awful lot. So then I tried to buy some other properties in the tax sale in this neighborhood again, and while driving around, I realized that I was putting myself in danger in this area.
No.
Terrible, because there were so many terrible houses and neighborhoods. So that was a big disappointment. I wasn't able to buy something for a low enough price like I've been doing before. So now, how do you go about finding wholesalers? So I have one girl that's doing works with Homevestors. You're probably familiar with that.
Yep. Yeah.
Yeah, and she has not been able to give me a deal. It's a small area. Lake County is only like 90,000 people.
Right.
And so, but it's a good area to invest in. So now my question is, well, how do I find wholesalers? And that's what I'm kind of struggling with
Right. So I know Lake County. I'm in Marin,
now. Oh
and
yeah,
which is so I'm a couple hours away. And in
yeah,
fact, we were well down the road of buying a mobile home park there until the county and city came up with nearly $400,000 in impact fees. So so that crushed a $2 million purchase. Um, the Lake County, like you said, is small, and there's the good side of the lake and the bad side of the lake.
yeah,
And it's very similar. You said the lake is it's very similar to Pensacola. So you go a couple miles, and it's a different world.
yeah,
And so, but that doesn't mean that there's but what it does mean is there is Lake County is really poor. You're going to find wholesalers out of Sonoma County. Um, but I also have a national REO connection, and if you'd send me an email, I can go run that up to the REO connection and see if they have, and I can put you on a list for anything that shows up there. Um, you said you hired the wrong contractor, but then it all came out okay. Do you think you have the right contractor for another one?
yeah. Actually, I do. Yeah, he came
Okay.
highly recommended, and I've tested him. So
Okay. Good. Good.
learn
Yeah.
my
So
lesson.
yeah, so I'd look at REOs rather than just tax sales. Um, there's some nuances, as you know, since you've done one. There's some nuance and specialty about tax sales that well, if you got, I look for what can I do over and over, and I can buy a foreclosure, clean it up, and sell it. You buy the tax deed, you've got to buy the tax deed, go through the clearing it, do a quiet title, on and on and on. But are you looking to hold for rentals, or are you looking to turn over properties as a business?
Yeah, no, I'm very fortunate that I have some cash, so
Okay.
an REO wouldn't be a problem for me because I
Yeah.
could just buy it, and then yeah, I wanted to rent it, remodel, rent, and then repeat. You know, the
Mhm.
burr.
Yeah. Yeah. And this example I did was an example of a burr, which is, for those of you that aren't on Bigger Pockets, Bigger Pockets has this buy, rent, rehab, buy, rehab, rent, repeat model, or buy, rehab, rent,
Refinance.
refinance, repeat. Yeah. And there's a good money source, again, in Sonoma County, that's been around forever and ever. I've known them for now a couple decades. Jeff Main at Sonoma County Equity has been a really good hard money lender for these kind of things. So,
Okay,
so,
so
yeah,
you have a good REO.
yeah, yeah, yeah. So I've got,
That's foreclosures, basically.
yeah. So I have a foreclosures and pre-foreclosures. I have somebody who's a national REO. I just imagine he gets a deck of cards every month and he deals them out. That's so yeah,
That's great. That'd be fantastic.
yeah. Okay. So send me a note, and I'll
Okay, thank you.
all
I
right,
will.
all right. So
Okay.
so
And then I have an also, excuse me, is a frog. Also do some hard money lending. Now, is it more profitable to do burrs than hard money lending in the long run? I think it is, right?
yeah, and I do both, and I try to balance what I have. Most of what we do is short term unsecured. So I'm looking for velocity of capital, looking to turn over money, um, doing financing projects for other flippers, maybe something that works for you in your county. And again, it's how you source those. And again, Jeff at Sonoma County Equity is um, happy to take your money, give you 7%, and then charge the borrower 10. So, but yeah,
That's
but his deals are, but the right people in that business, you should stay close to. In my history, I've been with the wrong people because I got too greedy chasing yield, and so I was making bets rather than investing, and have had a couple of projects where the developer has gone out of business mid construction. So
midstream. Yeah, yeah, yeah.
yeah.
So I would like to do more consumer loans. That would be safer, I
Mm-hmm. Mm-hmm. Yeah.
think. Yeah.
Yeah. So I've also done a couple of loans with I'm a licensed lender in California, and I've done a couple of construction loans for one of the big mortgage not mortgage real estate brokerages, where I go in and give the homeowner money to clean up the property, get it ready for sale, but not full construction projects. So I'm doing 6 month, doing less than 1 year loans in those. I've also bought a couple people out of foreclosure to help them save the equity in their house, and I've charged what you would think would be usury over usury interest rates, but they were in trouble. There was no way that they could borrow money from any traditional sources.
Oh, right. Yeah.
Yeah.
Okay.
And so those deals are, I'd come in and save the day, stop the foreclosure action, but they had to have a real estate agent in hand and already marketing the property. Yeah. Yeah. So
Right.
yeah, and those.
Okay, well, if you don't mind sending me those contacts, I would.
No, not at all. Not at all. Not at
Yeah,
all.
I was looking at Sunpack mortgages in Santa Rosa. I don't know.
Mm-hmm. Mm-hmm.
Yeah, and they just didn't have enough deal, and I had enough deals, and I have some money upcoming in a couple of months from one of my flippers, and I just need to reinvest it
Mm-hmm.
because
Yeah.
I need to feed myself and the cats.
That's right. That's right. Yeah. Yeah. Well, and you know, and we both know where we live that this statewide lockdown is put 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 everything on hold. So
Yeah, I know, and that wasn't good.
yeah.
Yeah. I didn't like getting a letter from the president, but I was happy with $1,200.
Yeah. I know people that were immediately sending a check to the Democratic National Party for $1,200. So and so anyway, but we don't talk politics here. Matter of fact, I try never to talk politics anymore.
Oh no, I'm not good at
Oh
talking
my goodness.
about
Yeah.
politics at all. And that was
No.
the only thing I wanted to say.
Yeah. So, so.
Yeah, thank you.
Oh, you're welcome. So, other
Anybody
folks?
else?
Yeah.
Steve?
Yeah. Yeah. Oh, hi, Bettina.
Yes. I have a question. How did you find Sunrise Acquisition Projects? I'm curious. How
It's
did you come across them?
well, it's the best kind of connections you have. It came through my brother-in-law who lives there,
Uh-huh.
and so we got not only did I get them, I also got him writing herd on making sure things got done.
Okay. Oh, that's great.
Yeah.
Okay. So you
Yeah.
have boots on the ground to make sure that all the moving parts are moving correctly.
Mm-hmm. Yeah. No, it's like the stuff I do and I'm doing in Gary with Dion DePauli. It's he's there. He's there.
Yes.
I
Right.
get a picture of him and the property manager standing in front of the place saying, "Man, how about this one, Steve?"
And those were the Section 8 properties that
Yeah.
you talked about?
Yeah. Yeah.
Yes.
Yeah. And
So I have another question. Does it have to be pertinent to what you presented, or is it going to be referenced?
If we don't get off track, it's not one of our phone calls.
Yeah. Okay. What about you had mentioned, and I remember you had talked about it a few sessions ago, about these short-term loans. They're not full.